The Fed said economic conditions are likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013. This is the first time since the introduction of the extended period language in March 2009 that the Fed has assigned a specific time frame to it.
Mid-2013, that's 2 years from now. And 5 years after the Fed began printing money and lowering interest rates.
But that's not all Bloomberg has to say on the matter. Bloomberg's Caroline Baum wrote, "Some economists suspect that yesterday's verbal gymnastics are prelude to some form of renewed action on the part of the Fed."
There's a good chance the Fed is just warming up the markets for QE3. After the dismal failure of QE1 and QE2, surely third time's the charm. Right? So, what's an investor to do? Watch as central bankers let inflation take over the markets? Or do you wait and see what happens before you feel it's safe to jump back in?
The endless talk about a bear market would send the toughest investor into the cave. And in the medium term, things aren't going to get much better. This isn't the bull market of 5 years ago.
You've heard before that this is a post-credit crisis environment. But how do you invest in this market?
Don't get out of the market, change how you invest.
Believe it or not, I think the coming years will be much better for investors. The days of front-running the Fed and boosting returns with margin accounts will be over.
Change is happening in the economy. And how companies spend their cash will be different in the future.
Simply put, companies that lived beyond their means in the past won't be able to do that in the future.